what is on the balance sheet? So as we know, it's A equals L plus OE. So if we start with the assets, there's going to be current assets, and you're going to see those definitions on an upcoming slide. There's fixed assets, which are generally land, buildings, equipment. Then you're going to see current liabilities, then long-term liabilities, and then from there, what's left over is the net worth. Now understand, at times, it is possible there could be a negative net worth, but it won't last long because hopefully somebody could have a bad year, but the overall net worth shouldn't be a negative. You lost money for 1 year, but hopefully there was enough left over that you're still, in the black, but you could have a negative net worth in 1 year. So let's break that prior screen down. Current assets always start with cash. Then you've got marketable securities. Now those could be just investments your company made in the market. You could own some stocks, you could own some CDs, whatever. The next is your accounts receivable. Then inventory, and inventory is generally always your largest, and then prepaids. So that's where you're paying car insurance up front or, anything that you need to pay in advance. Now, really important, the current assets are in order of liquidity. Your most liquid asset is always on top. So in your cash account, that money goes in and out every day. That's your most liquid. Then let's just say you needed money for whatever, it's a quarterly tax payments are due. You're a little low on cash, so maybe you'll check in on that CD or see if you have stocks, how they're doing, and maybe you'll cash in some stocks. That's your next. Of course, your receivables, depending on your terms, I'd like to say most people in America, depending on the industry, have like net 30-day terms, so you hope to turn that around. Obviously, in different industries, in the food industry, I think it's 7 to 10 days. If you're in transportation, trucking, it's 7 days, so on and so forth. But hopefully, you're turning that around in 30 to 40 days. Obviously, your inventory, as I mentioned in my example earlier, the inventory needs to be sold, and then that, when it's sold, assuming you have customers on terms, goes into your AR. So the inventory becomes receivables, and then it becomes cash when they pay you. So basically, that is current assets, and the definition is, includes cash, are those assets expected to be converted into cash within 1 year or one operating cycle, whichever is longer. Now, it depends. Let's say you're Boeing and you're making an airplane. And again, I don't know this, but in an example, let's say it takes 15 months to make an airplane, and maybe that's how they do their operating cycle. And that for them may be longer than the year. But everything that you plan on paying off within 12 months is a current asset, okay? And we'll remember that as we move forward, and I'll tell you more why. Then once you look on the balance sheet, after your current assets, you now have fixed assets. So you have land. If you own land, land is not depreciable. So if you buy land today and it's $2 million, it'll sit on your balance sheet as $2 million forever because it doesn't depreciate. Then would be buildings. So let's say you own your building. Or I shouldn't say own it, but you've purchased your building. And let's say your building was $10 million. That will be depreciated. And generally, on a monthly basis, most companies, depending on which method they use, because they'll go to what they call makers, M-A-C-R-E-S, and take a look at a building and say, okay, the building is depreciable, and I'm making this up, I don't know the exact time frame, we'll say 20 years. And depending on the method they're using, let's say it's straight line, every month, let's just say for the heck of it, they're taking off $30,000 off the value of the building. That would be a standard entry. So every single month, a journal entry would be made to reduce that by $30,000. And again, that could be for machinery, anything else. Then you can see the depreciation is next. So all those assets every month, it's kind of like buying your car, right? When you buy your car and you buy, $20,000 car, try taking it back to the dealer 2 months after you bought it and see what they'll give you. I think you'd be shocked. But it's depreciation, so that gets taken out every month. All right, now we've got long-term notes. So most companies, don't just start a company and they wait till they save up $1 million and then start it. Most companies are going to have to borrow from the bank, and they may get a revolving line of credit. They may get a note, and anything that's longer than a year will be shown in this part of the balance sheet. Because remember, it can't be a current asset, because a current asset has to be paid in a year. This will be a note. Now understand, in a lot of places, it's going to show current portion of long-term debt. So let's say you owe $10 million, and you have it over 10 years. We'll make it simple, so you owe $1 million a year. So if you're looking at that note, in the current and the current liability section, and you start on day one of the new year, there's going to be $1 million that's owed. And if you just got the note, let's just say you started the company, you got $10 million on January 1st. And that's what you owe on the note. On January 1st in the first year, under current liabilities, it's going to say current portion of long-term debt, $1 million. And then when you go down further to long-term notes, it's going to say long-term debt, $9 million, because that's the portion that's owed after the 1 year. So I hope that helps. Goodwill. Goodwill, for example, let's say you're buying a McDonald's franchise versus starting up, Joe's Restaurant on Main Street and wherever you live. If you're driving by Joe's Restaurant, people see it's a new place, but you don't know what business you're going to get, right? And you don't know who's going to show up. But trust me, if you buy a McDonald's and you have kids, those girls you saw in the first picture, they could see those golden arches 6 miles away. So when you're buying a McDonald's, and let's say the value of the brick and mortar and the sales, and again, I'm making these numbers up, I have no clue, is $3 million. Well, you may pay $3.2 million for the McDonald's because the fact that those golden arches are ready, everybody in the planet knows that's a McDonald's are going to draw business for you. So you're not going to go have to advertise in the local shopper to get people to come to McDonald's because the golden arches are already there. So based on that in the example I gave, if the McDonald's costs $3 million, okay, then you're saying 3.2 is what you paid. That $200,000 is going to be an asset to you in goodwill that you paid, and that goodwill is amortized. Intangible. So you may have some intangibles like a patent, a copyright. I've worked at many companies where we've had engineers that have gone out and developed something that they got a patent on. And again, those are assets to your company because you guys own them, and they're long-term. Most of them, I think, are like 20 years. So while you have them, that's also a value. If somebody else wants to buy your company, they're also then getting those assets. So overall, these assets produce economic benefits for more than 1 year for the company. All right, current liabilities. Now, sometimes when I'm talking about these things, I give my examples. I may repeat myself and jump ahead, but it kind of all ties in. So here we got accounts payable. Now, again, I'll jump down to the bottom. If current assets are everything, it's going to be in the first year. Current liabilities are the claims against the assets that must be paid in 1 year. or one operating cycle, whichever is longer. So most of the accounts payable that you have, unless you have really good customers that are giving you more than a year to pay, are going to be right there. Now, you may have some short-term notes that you went out and you had to borrow something for, let's just say you have a new project and you've got to hire some people as temps because you don't have enough with your current workforce. So for the next 6 months, you need to get a short-term loan. So again, if it's a short-term loan, less than a year, that's where it goes under current liabilities. Again, the current maturities of the long-term debt, go back to the example I gave you, the $10 million building, January 1st, and of course that first year, the $1 million is what is owed. So why is that important? Again, it depends on what your angle is, why you're looking at the balance sheet. Being a credit guy, we're looking at extending credit to somebody. So if I'm looking at their current liabilities and I see their payables are $500,000 and then their long-term debt is $1 million, that's $1.5 million that I know that they owe in the next 12 months. I'm hoping that when I look at the assets, mainly the receivables and the cash, that there's considerably more than $1.5 million, because then my question is going to be, how are they ever going to pay it? Granted, they could borrow, but at some point when you go to borrow, like if you go to get a car loan, the bank still owns your car. Well, if they go to borrow and they borrow against the assets in the company, if all your assets are getting tied up, it could be a concern for you. So that's why. And you got your accrued liabilities, which are the ones that you've already incurred the liability, but you haven't paid. Okay, so for example, you pay your people every Friday, so you paid them on the 27th of December, but then some people are working the first 2 days of the next week, and you close the month. You'll owe people for those last 2 days of the year. You have to include that in your expenses for the month of December. Even though you haven't paid these people and you won't pay them until January, you still need to go ahead and recognize that liability. If you don't, you will overstate your income for that month. But those also have to go on. Then, of course, there's taxes. If you owe taxes on a quarterly basis, monthly basis, those, again, as you know, are due within a year. So that's the current liability section of the balance sheet. Now, long-term. So we know that current liabilities are due in less than a year. Long-term, as the last bullet shows, are obligations by the company of greater than 1 year that need to be satisfied. So there you got your long-term note, as we talked, at $9 million. Now, you may have long-term notes to suppliers or owners, okay? So there are times in medium-sized companies or small companies that the owner puts some money in and it lets the company get through a tough time, but then the company is going to owe the owner back the money. Or maybe you have a big supplier and you do set up a note with them over a period of time. And so that could be another issue. There are such things as leases that you're going to owe, which are long-term, whether they're car, truck, or whatever. And, of course, if your company has a pension, then there's so much money based on the employees and whatever the setup for that program is that you're going to have to fund that pension. And there are some rules out there that you can, be underfunded so much. And again, I'm not an expert in this, but you have to have something like 70% of it. And then as time gets along, you need to have more and more of the pension liability that you're going to owe when your people retire in that fund. All right. Now, so we talked about the assets. We talked about the liabilities. And hopefully, as I mentioned, is if you, in your own personal balance sheet, your assets are greater than your liabilities, to find out what your net worth is, well, here's the same with a company. So where their net worth could be is capital stock. So the company starts out and they sell a million shares of stock at $1. So there's $1 million that people bought that are shareholders. Now, as the company's going on, and let's make the assumption they're doing well, their shares now start selling for $5 a piece. Well, that additional money, anything over $1, which was the initial price that they get above and beyond that dollar, goes into additional paid-in capital. So now if somebody buys 100 shares at $5, okay, that $400 goes there. And of course, the big one we hope to see is retained earnings. So every year, the company hopefully makes money. And of course, that's after, they look at everything they sold, paid all their bills, and let's say they make $1 million. Well, let's say they've been in business 3 years, and before then they had made $3 million in the first 3 years. And now in year 4 they make another, so now their retained earnings would go up to $4 million. So basically, if you were to look at the retained earnings on a balance sheet of a company as of December 31st of 14, and let's just say the retained earnings are $3 million. And let's say in 2015, at the end of the year, they make $750,000. And you would find that on their income statement. So if they had $3 million in retained earnings, you look on the income statement, and for 2015 they made $750,000. When you add the two together, you would now have a total of retained earnings of $3,750,000. Now, there are some things that affect that. If the company elects to pay dividends, and let's say they pay $100,000 in dividends, well, then your retained earnings account would only be $3,650,000, because the retained earnings would come out of that income before it's added on to the prior year. There's a couple other things which I won't get into, but just understand that's what retained earnings are. Treasury stock. So let's say the company sells stock to its employees. Let's say they want to buy some back. So if they do buy stock back, that's called treasury stock, and that's looked at separately. So overall, the shareholder/stockholder's equity is the residual interest in assets that remain after deducting the liabilities. So there you go again. There's the A less the L equals the OE. All right, so this is the owner's equity, net worth, equity.